How do you actually know if a stock is worth buying? For most people, you'll be better off just sticking with a low-cost, simple global ETF. But I know more and more investors like to tinker with a small part of their portfolio. So in this video, instead of just giving you stocks to buy, I'm going to show you the key things to look for so you can weigh up whether an individual stock is actually worth buying, with a few examples from the market right now. So where do you actually start? There are thousands of companies and you can't look at all of them. So you need a weigh in. Broadly, there are two ways people go about it: top down or bottom up. Top down is where you start with the big picture, the economy, where we are in the cycle, what interest rates are doing, and which parts of the market should do well in that environment. You settle on the area first, then go looking for the individual companies inside it. The economy leads and the company comes after. Bottom up is more or less the opposite. You leave the big picture to one side and focus on the company itself, what it does, how it makes its money, how it's run, and what it's actually worth. You're judging it on its own merits, and the wider economy is a secondary concern. The idea being that a good company is worth owning whatever's going on around it. You don't have to pick a side, and most people, me included, end up doing a bit of both. But either way, you want a pool to fish in to start with. That might be the FTSE 100, or a sector you actually understand, or even the holdings of a fund you actually rate. Just use as a list of ideas. The point is to get down to something you can work through, rather than just staring at the whole market. And as you go through them, put each one into one of three piles: yes, no, and too hard. That's an approach Warren Buffett's long talked about. The yes pile is the small one, worth looking into further. The no pile is the ones you can rule out quickly. Bad results, too expensive, something about it you just don't trust, and you just bin those. You don't need to agonize over them. And then the too hard pile, which is the one people skip but really shouldn't. It forces you to be honest that a company isn't always a clean yes or no. Sometimes you just can't clearly see how it makes its money or where it's heading, and that's fine. Those get rejected for now because you can't understand it, you can't value it. You're after a short list of companies you'd be happy to own at the right price. Most of this is throwing things out, which brings me to the first proper check, and it sounds obvious. Do you actually understand the business? Not the share price, the business. How does it make money? Who's paying it? And what would have to happen for that to stop? The test I use is whether I could explain in a sentence or two why this company will still be making money in 10 years. If I can't, it goes in the too hard pile. A retailer or a pub chain, you can get your head around. A bank's balance sheet, a drug company's pipeline, a mining company's reserves. Those are a lot harder, and there's no shame in deciding it's not for you. Once you understand it, the next thing is whether it's actually any good as a business. Plenty of companies you can understand perfectly well and still wouldn't want to own. Does it return decent profit consistently rather than just in one good year? Have their earnings been growing? If they pay a dividend, are they able to consistently increase it or at least maintain it? And has it got some kind of edge that stops competitors just turning up and taking the business off it? That edge might be a strong brand, its sheer size, something that makes it a hassle for customers to leave, or a position that's just hard to copy. An edge like that lets it hold on to its profits for years. Without one, it tends to get worn down over time, however cheap the shares look. You don't need to overthink this, but if you can't point to what keeps the business ahead of its competition, that tells you something before you go any further. Once a company's understood and it looks like a decent business, now you've got to work out if it's worth buying at today's price. The first trap is the share price chart. The chart tells you where the price has been. It doesn't tell you what the company's worth, but it's so easy to look at a line that's dropped and feel like you're getting a discount. Take Chevron, the big US oil company. It's currently well below its high, and you might think that there's a discount there. But that high came when oil spiked over $100 during the US-Iran war. The product they were selling simply became more valuable. But the price of oil has since come back down to the low 70s as things settled. So the share price didn't drop because anything went wrong at Chevron. It dropped because the oil price it follows came back to normal. There's no discount. The chart's just unwinding a spike. And the opposite trap. HSBC has been hitting highs up more than 50% over the last year. Looks expensive, looks like you've missed it. But a price can climb simply because the company's making more money than it used to. And that's mostly what's happened here. Strong profits and high return on its capital. A price sitting near its high doesn't, on its own, make a company expensive. So the chart on its own won't tell you whether something's cheap or expensive. You've got to put the price next to what the business actually earns. So how do you actually value a business? There's textbook ways to generate a valuation, such as using a discounted cash flow model, where you determine the investment's intrinsic value based on its projected future cash flows, and then discount those flows back to a present value to account for the time value of money. But realistically, as a retail investor, you're never going to do that. What you might want to look at is its price to earnings ratio. This tells you what you're paying for each pound of profit a company makes. It's simply the share price divided by the earnings per share. There's a trailing PE ratio, which looks at the earnings a company made over the last year, and then a forward PE ratio, which uses expected earnings for the next year. They both give you a rough idea of how relatively expensive or cheap a stock is, but it's also interesting to look at the difference between them, because it tells you which way the market expects profits to head. If the forward PE is lower than the trailing one, the market expects next year's earnings to come in higher than last year's. HSBC from earlier is a decent example, around 15.5 times last year's profits, but only about 11 times next year's. If the forward number is higher than the trailing one, it's the other way around. The market expects profits to fall, and that's usually a warning. A company can look cheap on last year's earnings, while the forward number is telling you they're about to drop. When those two are close together, you're normally looking at a steady business that nobody expects to change much. One thing to hold in mind, the forward figure is built on analyst estimates. So it's a forecast, not a fact, and they don't always get it right. But whichever you look at, a low PE isn't automatically cheap, the same way a high one isn't automatically expensive. A steady, slow-growing bank might sit on about 8 times earnings, and that's normal. A tech company growing quickly might be on 25 times, and that can be perfectly reasonable because you're paying for the growth that's coming. So on its own, the number tells you very little. It only means something next to 2 things: how the company's been valued in the past and what similar companies are priced at now. This is then where 2 big schools of investing come in: value and growth. Value investing is buying a solid, established company for less than you reckon it's worth and waiting for the price to catch up. Growth investing is backing a company you think will grow its earnings a lot faster than the market and paying a higher price now for that future growth. Neither one's right or wrong. They suit different kinds of company and they carry different risks. It's also important to look at the macro picture because some moves will be totally out of the company's control. The big one at the minute is interest rates. At the start of the year, it was expected that many central banks around the world would continue to reduce rates over the course of the year. But following the conflict in the Middle East and the subsequent spike in the price of oil, many have chosen to hold rates due to the potential for it to feed into higher inflation across the wider economy. So it means rates are higher for longer, and the Fed recently hinted that a rise isn't off the table either. That matters because rates move whole sectors regardless of how well the individual companies are run. Banks tend to do well out of higher rates. They earn more on the gap between what they lend out and what they pay out. Anything that leans heavily on borrowing or that people mainly buy for the income tends to have a harder time. Property companies, utilities, infrastructure, their borrowing costs more and the income they pay looks less special when you can get nearly 4% sitting in cash. So a utility being down isn't necessarily a problem with the utility, it might just be rates. And when rates eventually come back down, that pressure comes off. That's the kind of reason that can actually be an opportunity, because the thing weighing on the price is temporary and the business itself is fine. The oil price has come down in the last couple of weeks, but it's the kind of conflict that could reignite at any moment. So it's not quite that straightforward. A stock can look cheap for many reasons. The key is determining whether it's just sentiment or something more structurally wrong with the business. Let me give you 2 examples that both appear cheap right now, but for completely different reasons. WPP first, the advertising group. It used to be the biggest in the world. The shares are down heavily over the past year, trading near levels they haven't seen in years. And at the end of last year, they even dropped out of the FTSE 100 after nearly 30 years in it. So on the chart, it may look like a bargain, but look at why. It's lost some huge clients, Mars and Pepsi among them. Clients are pulling more of the work in-house, and AI is starting to do things agencies used to charge a fortune for. They cut the dividend by more than half, which is a sign this is more than a bad year. Some are buying it as a recovery play, and they might turn out to be right, but it's cheap for a structural reason, And that's exactly how a value trap works. The price keeps looking cheap and keeps drifting lower because the business underneath is actually shrinking. Then Sanofi, the French drug maker, also down, the lowest it's been in years, well below its highs it hit early last year. And cheap on the numbers too, on about 8 times next year's earnings, when the rest of the sector's nearer 17, and below its own 5-year average. But the reason behind it is completely different. The main weight on the shares is worry about US drug pricing, the threat that the American government leans on the whole industry to bring prices down, which hangs over every drug company, not just this one. On top of that, they're partway through splitting off their consumer health arm to focus on prescription medicines, and markets are never keen on that kind of upheaval while it's going on. None of that is the actual business going wrong. Underneath, it's doing fine. Its biggest drug, Dupixent, grew about 30% last quarter, and they expect it to bring around 22 billion euros a year by 2030. The last set of results also came out ahead of forecasts. Both companies may appear cheap, but it means 2 completely different things. With WPP, the business itself is in real trouble. With Sanofi, it's a good business, people have just gone off for now. That's the call you're really trying to make. And there's one more check before you go near anything that's struggling, which is the balance sheet, mainly the debt. A cheap, troubled business is far more dangerous when it owes a lot, because the interest carries on whether trading's good or not, and it can go under before any recovery turns up. You can see in these two, Sanofi's balance sheet is strong, so even out of favour, it's in no danger of falling over. WPP is the riskier one, carrying a couple of billion in debt, with its borrowing creeping up while revenue falls, which is a fair part why the dividend had to go. You don't need to become an accountant, you're just making sure it can last long enough for the recovery you're betting on to actually arrive. If you're after a dividend-paying stock, one of the biggest traps is the yield. A big yield is what attracts most income investors, but it can also hide a lot of red flags, because a yield climbs 2 ways. Either a company is lifting its dividend, which is what you want, or the share price is falling, which pushes the yield up all on its own, and that's often the market warning you it thinks the dividend is in trouble. So a fat yield on screen can be a sign of strength or a sign of trouble, and you've got to work out which. Take Pfizer. It yields just over 7%, but it's worth knowing why it's that high. The share price fell a long way a few years back, largely as COVID revenues dried up. It's been fairly flat since, which has just left the yield sitting high up there. And the dividend itself isn't really covered. Pfizer's paying out more in dividends than it earns, with the payout ratio sitting around 131%. On top of that, there's a patent cliff coming. A couple of its biggest drugs lose their protection over the next year or 2, which could reduce profits. So that 7% isn't the deal it first looks like. It's the market telling you it has real doubts about whether the dividend holds. Then Vici, it's a US property company, a real estate investment trust that owns big Las Vegas casino buildings, places like Caesars Palace and the MGM Grand, and rents them back to the operators. The yield's similar at 6.6%, but this one's covered comfortably. The dividend takes up around 61% of earnings, and that income comes from leases that run for decades with inflation rises built into them. And they've put the dividend up every single year since they listed back in 2018. So here, the same sort of headline yield is a reliable growing income stream because there's contracted money sitting behind it. So don't just buy the yield, look at what's actually paying for it and whether that can keep going. So let's pull this together. When something's caught your eye, the run of questions is roughly this. Do I actually understand the business? Has it been performing? Is it genuinely cheap? Or has the chart just moved? If it's cheap, why? Is that reason temporary or terminal? Can it survive long enough to come good? And if I'm buying it for the income, is the dividend actually covered? Get through that lot and you'll have avoided some of the biggest traps. A lot of the time, the answer is going to be no, not yet, or too hard. Don't force investments that are just not there. Genuinely good opportunities are going to be rare, and there's nothing wrong with sitting on your hands waiting for one that's clearly worth it. And when you do find one, you don't need many. I'd rather own a handful of companies I've actually thought about than 30 I'm just hoping come good. When something ticks all the boxes, that's where the money goes, not spread thin across a load of half-baked ideas. One thing I'd really recommend doing is writing down why you're buying something and what would make you sell it before you put any money in. Doesn't need to be much, just a few lines. Because once you own it and the price is jumping around, it's very easy for emotions to take over. If it drops and your reasons still hold, you sit tight. If the actual reason you bought is broken, that's when you can look to sell, not because the price had a bad week. If you found this useful and you want help with your portfolio or just to discuss ideas with like-minded people, I run a Discord community called Zero to Investor. It's the top link in the description below. Thanks for watching, and I'll catch you in the next one.